Market prices do not move simply because there is an imbalance of buyers and sellers. They move because large institutions actively engineer situations to find liquidity. Large institutions operate at a scale that creates a massive logistical problem. They cannot simply execute billion-dollar block orders at market price. If they tried, their massive size would consume all available orders instantly, causing severe slippage that moves the market against their own positions. To solve this, institutions need you. They require intense public participation to act as the counterparty to their massive trades. They wait for retail traders to experience a fear of missing out, intentionally drawing in the heavy liquidity they need to safely execute their own positions. This massive transfer of ownership leaves a distinct footprint on the chart. In volume spread analysis, it is known as the Climactic Action Bar. This is a Climactic Action Bar. After an extended uptrend, a wide bullish candle appears with an isolated, massive volume spike directly beneath it. Retail buy orders crash into and are absorbed by hidden institutional limit cells localized within this single candle. Demand is neutralized. This heavy absorption makes the footprint a signal to pause. While it proves professional money is active, the time frame for the completion of their accumulation or distribution remains unconfirmed. To actually trade this footprint, we must establish the proper background, define a strict operational range, and decode the 3 algorithmic execution strategies institutions use. Ultra-high volume at a trend extreme marks the completion of institutional business. This massive transfer of ownership creates the structural foundation for a reversal. Volume spread analysis dictates a cardinal rule. A climactic action bar is mathematically meaningless if analyzed in isolation. Every volume spike must be read against the broader market background. For a climactic action bar to be valid, it must form at a critical location, rejecting exactly at higher timeframe resistance. Once professional selling occurs, it instantly triggers a downward price vector called an automatic reaction. Drawing rigid horizontal lines at the extreme wick and the automatic reaction's low establishes the Kesting range. Institutions will now use this defined range to test for any remaining supply or demand from retail traders. The way price behaves inside these 2 strict boundaries dictates exactly which of the 3 execution strategies you must deploy. Strategy number 1 is direct confirmation. This is the fastest, cleanest institutional execution model you will ever encounter. Notice the price action here. Institutions have completely filled their necessary quotas inside the climactic action bar. Because they require 0 additional liquidity, price drifts sideways briefly, then violently breaks downwards through the automatic reaction boundary without ever retracing near the upper extreme. Late retail traders who bought the top are instantly trapped. Their positions are deep in the red, forcing mass liquidations. Those forced stop-outs act as fresh sell orders, providing the exact fuel needed to accelerate rapid, explosive momentum in the new downward direction. The actionable entry checklist for this strategy starts here. First, confirm the valid market background, and second, identify your testing range boundaries. Next, confirm that price fails to retrace deeply toward the upper limit. You execute the entry strictly on the decisive candle close beyond the automatic reaction boundary. Direct confirmation relies entirely on overwhelming immediate absorption. It prioritizes the sheer speed of momentum over setting complex traps. Strategy 2 is the liquidity sweep. Professionals prioritize this model because it accounts for the precise mechanical behavior of market participants at extreme levels. In this scenario, the immediate drop doesn't happen. Institutions require one final, massive influx of counterorders to finish building their short positions before initiating the full reversal. They target where retail traders naturally cluster stop losses, directly above recent highs. The market pushes price up, briefly pierces the extreme line to trigger those stops, consumes the liquidity, and violently rejects downwards into the range, leaving a single long wick. This creates a perfect psychological trap, tricking breakout buyers into false positions and flushing out early smart money sellers. For the liquidity sweep, Phase 1 of your entry checklist requires you to wait patiently for price to revisit the absolute extreme of the climactic action bar before acting. Phase 2 requires you to confirm the sweep itself, a clear pierce and immediate rejection. You enter the trade the exact moment the candle closes back inside the operational range. The liquidity sweep is highly reliable because it mechanically weaponizes predictable retail stop-loss placement to finalize institutional positioning. Strategy 3 is delayed confirmation. This is the slowest execution model, and it strictly tests a trader's patience. Institutions require extended time to absorb remaining orders. Price meanders entirely inside the testing range, forming a dense consolidation block. A volume profile shows a heavy central buildup, the exact point where institutions absorb supply. Finally gaining control, professional money forces a decisive, high-volume price drop out of the equilibrium zone. Your actionable entry checklist mandates observing a minimum of 5 to 10 candles of consolidation, strictly inside the testing range. Do not act early. You complete the checklist and enter the trade only upon a decisive, high-volume close entirely outside the consolidation block in the reversal direction. Delayed confirmation trades the speed of the other setups for extreme structural reliability. It demands patience over prediction, waiting until the market imbalance is mathematically proven. Look at the whole picture. These 3 execution models are not isolated patterns. Together, they form a complete matrix of exactly how institutions finalize accumulation or distribution. The liquidity sweep remains a high-probability setup because it perfectly integrates with smart money concepts, relying on the mechanical stop runs that fuel institutional sizing. But strict risk management is mandatory. No volume strategy is flawless, and even perfect climactic bars can fail if the broader market structure shifts. You must have an absolute invalidation rule. If a climactic action bar forms, but the subsequent price action slices cleanly up through the highest extreme with continuous high volume and zero rejection, the setup has failed. If price closes decisively beyond that upper boundary without a sweep or rejection, the institutional thesis is mathematically invalid. The trade must be aborted immediately. The appearance of a climactic action bar demands a period of observation. A trader must wait for price to interact with the established range before confirming an institutional direction. This comes back to a core Wyckoff principle. Volume measures the raw effort of professional activity, but only the subsequent price action confirms the actual result of that effort. Successful quantitative traders do not try to predict market turns. They identify the institutional footprints, await structural confirmation, and trade the definitive result. You buy the dip because the trading setup looks absolutely perfect. Then, without any warning, the price floor suddenly collapses. Institutional traders engineer these sudden drops to trigger retail stop losses, absorbing the specific liquidity they need to build their own massive positions. Identifying these institutional entries requires a technique for spotting the climactic action bar, or CAB, a high-volume footprint that marks the exact moment big money enters the market. This setup requires only 2 tools, a standard candlestick chart and a volume histogram to track the intensity of market participation. Mastering the CAB setup provides a technical framework for anticipating institutional intent, allowing you to move from a reactive retail buyer to an informed participant. We begin with a healthy bullish trend, defined by a consistent sequence of higher highs and higher lows. Within this trend, we look for a retracement. This is a pullback consisting of multiple consecutive red sell candles moving against the primary upward momentum. Focus on the volume histogram during this downward move. You are searching for a single, massive volume spike that towers over the surrounding bars. This spike corresponds to a specific price candle on your chart. This anomaly is our climactic action bar. A valid CAB typically displays a wide spread, meaning the distance between its high and low is significantly larger than the candles preceding it. This extreme volume signature serves as empirical evidence that institutional buyers have stepped in to halt the retail sell-off. To trade the CAB, we must first map its boundaries. These lines will act as the proving ground for the market's next move. Pinpoint the absolute high of the CAB candle, ensuring you include the very tip of the upper wick. Use your horizontal line tool to mark this peak. This is your upper trigger line. Now, repeat the process at the absolute lowest point of the candle's wick to establish the lower trigger line. We now have a contained channel. The price action that follows will dictate whether the setup is ready for entry. First, we wait for a liquidity sweep. A subsequent candle should dip below the lower trigger line to trigger retail stops, but its body must ultimately close back inside the channel. This sweep candle requires significant participation. Its volume should reach at least 70. Low volume on a breakout proves institutional selling pressure is exhausted, creating a vacuum that allows the price to move upward with minimal resistance. Place a buy order at the low volume breakout candle's close, or set a buy limit at the upper trigger line. Set your stop loss below the sweep candle's lowest wick, the definite low. Target the previous structural high for a massive risk-to-reward ratio. With the setup confirmed, the price is free to move toward the previous high as the broader trend resumes. For conservative management, close 70% of your position at the first structural target and move your remaining stop loss to break even. Executing based on the CAB turns the market's traps into your entries. Open a 5-minute chart today and begin identifying these high-volume bars within your favorite bullish trends.